Hi, I'm Joe Guinan. I'm sitting here with market strategist Andy Busch, and we're going to ask him a few questions about what's going on in the economy and what's going on with Fed policy. Now, sometimes the market has this view that there's a Fed put. So if the stock market sells off enough, then that ties the Fed's hands and they can't raise rates. And they won't go to 25 or they won't go to 50 or they won't go to 1% because the stock market has sold off 5 or 8 or 9 or 11 or 13% or whatever. Do you think that model is still viable, or do you think that people banking on a Fed put is a bad trading decision?
Well, last year we were up, the S&P was up around 15%, the year before over 30%. I don't think the Fed has to worry about that anymore. I mean, there is volatility involved in there, and it is disruptive to the financial markets and to business because of that. But I don't think we're in the Bernanke put anymore. I think the Fed needs to really make it clear to the markets that they need to raise rates and normalize rates because it's dangerous if you don't. So I would say the S&P, to me, if we want to use a time frame that's analogous to I think what's going to happen here, I would say it's the 70s. I would say we're going to be in purgatory for a little while where we trade between like maybe 1900 and like 2100, 2200 because there's really no reason for us to go up dramatically unless the earnings substantiate it, and they may, but there's some headwinds there obviously, but we're just, as far as I'm concerned, as far as the Fed goes, they're aware of that. They may make some commentary about it, but it is not going to be the driving force for them, of course, until you drop 500 points.
I agree with you. I believe the Fed put will be gone, and but I also think there's potentially even more downside. I think 19 to 2100 is a little too narrow a band, and maybe they take out the bottom end of that band.
Like 1700. Yeah, it could potentially be there for sure. Smart guys like Joe Dahlia over at Bridgewater have said, hey, no, really, this is more like the 1930s. Mm-hmm. And he's very, very circumspect on what the S&P can do from here, maybe even thinking that it could drop, over 30% from these levels if it's analogous to that time frame. I would say we're not in that time frame. We've changed so much. There are similarities. Certainly, the fiscal tightening that's gone on under the sequester has kind of represented a little bit of what happened during the 1930s as well. But I think this Fed is very, very aware of not only that time frame, but also under the Greenspan regime where we had those 17 rate hikes of 25 basis points each. I think this Fed will get to 1%. They'll tell everybody they're pausing for a while. Then maybe get to 1.5%, pause for like 6 months, because they really don't want to, hurt the stock market. They don't want to cause disruption, but they also don't want to just make it like we're going to inflate and see the wealth effect and cause inflation that way.
Yeah, I agree with you. I think 1937 is an unfair comparison, and I think he's got it wrong, and I agree with you. Well, thank you very much. This is Andy Busch, market strategist. I'm Joe Guinan from Advantage Futures. Please visit our website at advantagefutures.com. Thank you.